So a few days ago, Alibaba Group has just reported their earnings on the 25th of November after the Hong Kong market closed. And the following day, on the 26th, Alibaba essentially traded flat or was down rather 1 to 2%. But in fact, one of its closest, fiercest, and strongest competitor in the food delivery space essentially gapped up by more than 5%. It boils down to this one sentence coming from the CFO of Alibaba Group, Toby. And this was what he said, and I quote, "I think likely the September quarter will be the quarter during which the scale of those investments are the highest," unquote. And when he's referring to those investments, he's specifically identifying the quick commerce and e-commerce business, which is closely linked to this huge food delivery war that was started 1 to 2 quarters ago. So in this video, I'll be heavily emphasizing on what Alibaba's management team has just reported, and more importantly, give you my own personal read of the latest earnings results. And in fact, Meituan has also reported their earnings in that same week on Friday after the Hong Kong market closed. So for Meituan's US ADR, the market didn't seem to be very spooked by the horrendous earnings number results. And that aside, for those of you who want a deeper dive into my understanding of Meituan's recent set of earnings, feel free to leave in the comments below. I'm not too sure if there's demand there or not. And all things considered, to give you a bit of flavor in terms of my own personal portfolio exposure, as I've alluded at the start of this video, I think it pains me to see two of my most promising kids doing this sort of hooking and jabbing at each other and just fighting it out in the ring itself. No doubt, even though Alibaba is my largest allocation by far at roughly 27% or 26.5%, but Meituan is no small position as well at a 6.4% allocation and a 22% negative unrealized loss. For those of you who are looking for a trustable all-in-one portfolio management platform, I am personally using Portsedo myself, and they are running a Black Friday sale which expires on the 1st of December, which is in 1 to 2 days time. I have been an avid user of Portsedo for close to half a year now, and in fact, I've actually personally subscribed to the Pro annual plan here as of the 1st of June. So I think especially for retail active investors like you and me, I think a very, very important benchmark that we always tend to forget, or thinking that we are outperforming the market, but the data might show otherwise. So for myself, I do operate multiple portfolios on different brokerage platforms. And Portsedo here really allows me to aggregate everything and to give me a very objective and a very substantial view of how I have been allocating my money and whether I am beating the market or not. And one of the most critical value add of Portsedo's platform is really a bird's eye view of comparison towards different benchmarks. And here, of course, I've picked up a few of the most popular names like the S&P, the QQQ. When you look at my own individual portfolio, my annualized basis for the last 4 to 5 years is roughly 15.5%, S&P is at 14.2%, and QQQ is at 19.6%. And some of you might be wondering, since when did QQQ offer an annualized rate of close to 20% CAGR, or compounded annual growth rate? And what's the amusing thing about Portsedo is that they essentially run a parallel portfolio into understanding when did you inject capital into your own personal portfolio, and they mirror it exactly, assuming that you put it into this individual benchmark indexes as well. And yes, I think investing requires a relatively long time horizon, and I'm still catching up with the Nasdaq or the QQQ. But I think the most important thing is to give yourself a very objective way to assessing your own investment performance as a fund manager of your own capital. And not forgetting the fact that they do have other features such as analyzing your previous trades, creating some sort of a goal tracker for yourself, and not forgetting the dividend income tracker. So for those of you who are interested in such a strong and smart performance analysis tool, then do give Portsedo a shot. They are running a Black Friday sale, so don't miss that out. Now, going back to the video. So before Alibaba reported their earnings, I have actually created a previous so-called forecasting video into my own personal understanding and what I do expect coming out from the business earnings call itself. And I came out with 5 key points. Firstly, we want to know about the margins and the hint on any upcoming spending or the lack thereof. Secondly, looking at cloud, we know that it's going to be above 26%, but how much higher? And we need additional commentary from the management team on whether the demand continues to stay unsatiated. Number 3, I think quick commerce cash burn. They want to know what kind of ROI and are there any synergies to justify. The fourth point, in terms of the core commerce business, are there any signs of stabilization or even grabbing back market share? And lastly, are there any hints or guidance on the 11/11 sale? So going down the list one by one, on the first point about margins and the hinting on the upcoming spending, I think you can look at that from two terms, because I did not specify what kind of spending we're talking about. Is it in terms of the cloud capital expenditure or is it on quick commerce? But I think back then when I was doing the video, I was squarely focused on capex because quick commerce was the third point. So on capex, I think this question from Ronald, he asked, how should we think about the capex going forward and the incremental revenue driven by this capex? So we can tick off this first question on our bingo card. Secondly, looking at cloud, I think we are really thinking about the demand. And for Gary, he did ask the question related to cloud business, how should we look at the growth outlook going forward? So I think it's quite safe to say that demand still outstrips supply in the foreseeable future. Moving on to point 3 in terms of quick commerce and its synergy exactly down the line. Kenneth Fong asks, can management share some key progress for quick commerce and the synergy to our core e-commerce so far? On point number 4, in terms of stabilization and grabbing market share on their core commerce business, so the CFO did guide that, excluding losses from our quick commerce business, our Alibaba China e-commerce group, EBITDA, would have grown at a mid-single digit year-on-year for the quarter. So it seems like, at least on an earnings basis, there is some sort of a stabilization in terms of market share. But it's not a direct question being asked by analysts itself. So we are currently 3 out of 4. On the last point about 11/11, unfortunately, there is no questions asked at all for 11/11. That said, I think in their own disclosure, they did cite that they had a successful 11/11 global shopping festival and they delivered double-digit consumer growth year-on-year on the Taobao app. So at least on our current bingo card, we got 3 out of 5 where analysts asked 3 of our questions. I'll take it as that at least it's passable. But of course, for my Asian background, getting 60% out of 100 is unforgivable. So I hope that they don't disown me. Christmas came early this year for anyone who hasn't opened a Weibo account yet. So Weibo Singapore is a MAS licensed broker and they've just upsized their welcome rewards for new users from now until the 31st of December 2025. So if you deposit and maintain at least 3,000 Singapore dollars for 30 days, you'll get 70 Singapore dollars worth of Apple shares. And if you use my link below, you get an extra $30 of Apple on top of that. And for those of you with a larger capital size, looking for higher short-term yield on idle cash in this falling interest rate environment, Weibo is basically playing center. Maintain a daily net deposit of at least 10,000 Singapore dollars and you unlock the base tier of 1% per annum interest being paid daily for the next 180 days, with the bonus rate actually scaling up as your capital goes up. Plus, you can earn an additional 1% per annum bonus interest if you complete 6 buy trades within those 180 days. So to crunch the numbers for you, if you're based in Singapore, you are new to Weibo, you sign up using my link below, you deposit 10,000 Singapore dollars and you make 6 buy trades and simply maintain that amount for 6 months, which is equivalent to 180 days. In total, you'll get about 280 Singapore dollars worth of Apple shares plus roughly $100 in interest from the 1 plus 1% per annum welcome rate over the next 6 months. And that's before any other potential returns if you choose to park the money in money market funds, ETFs, or even deploy them in this current volatile market environment. So this welcome offer is only for new Weibo Singapore users. So if you've been thinking about opening an account, I think this is the best time to do it. So use the link below to unlock the extra Apple shares and bonus perks today. So on the top line, they've grew by roughly 5% year-on-year, but on a like-for-like basis, they actually grew 15% year-on-year, if you stripped out the disposed Sun Art and In-Time business. So I think you can see that Alibaba really was at an inflection point compared to, let's say, a year ago, where they're really starting to re-accelerate their growth again and trying to be a lot more strategic and focused in terms of their emphasis. So after stripping off this Sun Art and In-Time divestment, we are going to see a much more cleaner breakdown of the business. And not only that, I think also monitoring their margins after they normalized. We are probably going to see so-called higher quality revenue or higher quality profits as the margins are expected to expand again after they pull back in terms of their investments and expenditure down the line. Profitability essentially collapsed. I think operating income fell 85% year on year, and operating margin dropped from 15% to a mere 2%. Sales and marketing doubled from 13% to 26 or 27% of revenue, and capex was roughly 120 billion RMB on a trailing 12-month basis. And most of it has been a full-on commitment to their cloud investment. So free cash flow essentially evaporated. The operating cash flow dropped 68%, and their 6-month free cash flow went from 31.1 billion positive to a negative 40.7 billion RMB. So in terms of their main business segment, I'm just going to cover 3 of them: China e-commerce, international, and cloud. So for China e-commerce, on top line, they grew revenue 16% year on year. Consumer management revenue, their highest margin, so-called advertising revenue, is also up 10%, citing higher take rate, which is a step in a positive direction. Even though management did guide in the following quarter that this growth will slow down because of the new re-rated higher base. So for the sub-segment for this China e-commerce business, it's called quick commerce. It's up 60% year on year to roughly 23 billion RMB, even though they did say that the unit economics substantially improved, but I think based on my own assessment, it's still lousy. Moving on to their international arm, AIDC, it's up 10% year on year, and they started to turn a small profit. And more importantly, moving on to the crown jewel of this new business arm, as they try to transform the entire Alibaba group, cloud is up 34% year on year, and they did bring in a triple-digit growth for the 9th consecutive quarter on their AI-related cloud revenue. And yes, we are lapping or going into this 3-year cycle. Ali Cloud is sitting at roughly 36% market share, and they're bigger than the 2nd, 3rd, and 4th player combined. And this is also the first quarter that Ali Cloud has eclipsed the international commerce arm's revenue in a quarter. So I think moving on, we will see it continue posing such high growth rates, and it will be one of the biggest growth drivers moving forward from here. And moving on to their balance sheet, and in terms of some of their capital management, share repurchases for this quarter is negligible. They have a remaining of roughly 19.1 billion US, effective through March 2027. They bought back a little bit, but shares outstanding is still kind of flat quarter on quarter. Balance sheet wise, the net cash fell from 366 billion to 292 billion RMB, and that's roughly 41 billion US dollars. So for myself, how I would read this set of earnings is that I thought everything was pretty in line with expectations. And like I suggested, I think markets are pretty forward-looking, and they want suggestions or hints on spending, how would growth look like in cloud and commerce, and the current beat or miss won't move the stock much. So 2 top-of-mind kind of make or break pieces is really what's your bull or bear case for China's cloud business. There's a typo here. Is there a huge total addressable market? What is the ultimate demand looking like? I know we all know that it's a long tailwind ahead, but will there be good margins, and how is Alibaba able to extract these margins and earnings down the line? And second in line is that, do you buy into the investments of the quick commerce arm, and will they really be able to bring any sort of synergies and market expansion for the bigger business or the main business? And to what extent or how well is Alibaba able to defend their market share moving forward from here as they eventually scale back in terms of their sales and marketing? Now, since we have these 2 main questions in mind, I've essentially extracted some of the quotes from the back and forth from analysts and management team. So the management basically iterated that they're going all in on AI plus cloud and consumption, which is their quick commerce ecosystem. And they try to enrich this through many more touch points and trying to be in the entire habit feedback loop of the Chinese consumer mind. So Eddie continues to toot the AI cloud horn with his conviction being sky high. And I quote some of the things that they mentioned. So the pace at which we add new servers is insufficient to keep up with the growth in customers' order. Looking ahead, at least for 3 years, we do not really see much of an issue in terms of the so-called AI bubble. The renminbi $380 billion figure that we mentioned previously might be on the small side, certainly in terms of the customer demand that we are currently seeing. But if I were to rephrase what the management think about the ROI or the return on investment of all these investments, they basically just said, I don't know, man. And I quote, I don't think it's really possible to make that kind of estimate, at least for the time being, because overall, the AI sector is still in the early phases of development. Moving on to quick commerce business, I think things that improved is that their per order loss since July and August basically cut by half. The average order volume is also up by double digits, and more than 75% of their orders are now non-beverages. Because we all know at the start or at the peak of this entire food delivery war, they're basically just offering like 1 RMB a bubble tea, and that we know has very low margins, and they're just there to kind of clock the number of delivery orders per day. And for quick commerce, they now have over 100 million daily users. So seeing some of the synergies, they did cite that Fresh Hippo and the Tmall supermarket quick commerce orders are up 30% from August. And our goal is to generate more than 1 trillion RMB in GMV, gross merchandise value, for the quick commerce platform within the next 3 years. And as efficiency improves and the unit economics improves as the scale of the business stabilizes, by next quarter, a significant sizing down in the scale of those investments. And we will dynamically adjust the pace and the size of our investments in line with market competition. In short, if I were to rephrase it, they are taking cue now from Meituan and maybe by a very small extent JD. If Meituan is going to start jacking up their investments into spend in sales and marketing, Alibaba will just say that in Chinese it's called 奉陪到底. I will continue playing with Meituan. But at least for now, I think there is some sort of a truce being made here that they both will start scaling down in terms of their investments and spending in this quick commerce food delivery business. Now, to give you a little bit more perspective in terms of what investors are currently underwriting to kind of really appreciate better of what this quick commerce spending looks like. So if you take a look in terms of the latest quarter ending September 30th, you see total revenue grow by 16%, even though yes, quick commerce is the largest growth pie by more than 60% year on year, but adjusted EBITDA actually went down by 76%. So to kind of understand how much they basically burnt on quick commerce, assuming that the EBITDA actually grew alongside revenue growth rate, so which is 16% here. And when we do the numbers, 44 billion multiplied by 116%, they should have kind of delivered 51 billion on the bottom line adjusted EBITDA number. But they delivered instead 10.5 billion. So it means that, long story short, 41 billion is being burnt somewhere in the e-commerce arm. Is it totally kind of attributed to quick commerce? Not really, because if you remember in one of the management guidance, they did say that EBITDA is supposed to grow in kind of mid-single digit, but I think it's quite safe to say that a disproportionate amount of money is allocated to kind of build out this quick commerce arm. But of course, I think some investors would jump out and say that, hey, I think compared to Meituan has already went into loss-making or operating loss-making, but at least now for Alibaba, they're still EBITDA profitable. But I think let's not forget that all this money is still considered shareholders' money. It's investors' money. It's yours and mine money, especially if you're invested. It's still a very, very painful exercise because all these additional income can be used to supplement many of Alibaba's other businesses. And this quick commerce arm is clearly one of the lowest ROI and lowest margin way Alibaba can engage in. You have your cloud, you have your AI, you have so many other things that you're putting money into as well. So at the end of the day, I think it depends on the objective of the management team. I think by reading in between the lines, they really just wanted to get a skill and to get a habit up. So I can understand where the management is coming from, but I'm not necessarily very appreciative. And I do hope that at least in the next 2 quarters, moving into 2026 especially, they start to scale down very aggressively in terms of their spending here. And also, another segment for discussion here is that, Alibaba still has so much money on their balance sheet. Just burning out $30-40 billion, not really a very big issue. So my answer to that is yes and no. Yes on the fact that on their balance sheet, on the net cash position, they have 292 billion RMB. That's on the positive front. But let's not forget on the other side of the ledger, the remaining obligations are also humongous. For one, I think in terms of the share repurchases, they did commit to roughly 134 billion RMB, which of course we all know that can be delayed or cancelled because back then Alibaba shares were very undervalued. They want to put out a huge repurchase plan. For now, they start to turn back into a growth stock, and in fact, based on compared to 2 quarters ago, their shares outstanding started to inflate back a little bit. So you can cancel that for all you want if the ROI on AI and cloud is big. But not forgetting the fact that they also committed roughly $380 billion for their cloud infra plan or build out in the next 2 years. They've already spent 120 billion. They are going to spend another 226 billion. And in fact, they did guided that it might be on the lower end, meaning that They want to anchor the 380 billion on a base case, and they want to increase it even more. So the 292 billion that you see on the balance sheet today is really not much in the grander scheme of things. You can kind of essentially write them all off because they're going to basically plow everything back into the entire cloud infra build up. So yeah, so in a very, very grand scheme, the money here that we are working with is really not too much per se. And in terms of the food delivery war, just to shed a bit more light, I've came across this very interesting infographic, both on X and on Snowball, which is the equivalent of finance Twitter in China. According to a Chinese food media report, food delivery has burned through roughly 14 billion US dollars in the past 2 quarters. And now, in November of 2025, Baba and Meituan got a close order volume, but the GMV market share is still 6:4. And Alibaba's unit economics has improved a lot in the past quarter, but the loss per order has been cut in half, but there is still a 2 renminbi difference in unit economics between the 2 platforms. So to give you a bit of understanding here, you can see that both Alibaba and Meituan is delivering roughly 75 million daily orders. So the entire market is roughly 180 million daily orders, with Jingdong doing 20 to 30 million, or JD.com. But that said, if you look at it in terms of their economics of every single order that they deliver, how much money they're currently losing, for Meituan, it's close to roughly 80 RMB cents per share, negative. But for Alibaba at least, it's closer to negative 2 RMB per order here. So they've improved leaps and bounds compared to July to the November quarter, from more than 4 RMB loss per order to now 2 RMB loss per order, which is the scale that we talked about. They wanted to build the scale out first, so in order to get that flywheel started. And for now, looking at their loss ratio, they kind of achieved their objective with the demand scale and also improving unit economics. But in terms of execution-wise, I don't think they come anywhere close to where Meituan is sitting at least for now. So they are projecting that by Q2 of next year, Meituan will start to go back to positive again. So in terms of the spending-wise as well, to kind of pivot back to understanding how much they have essentially burnt, and doing some sort of a back of the envelope calculation, assuming that they can do 75 million orders a day for the last 90 days in the September quarter, and they lost a blended roughly 3.5 renminbi per order, that means that they burnt roughly 23.6 billion for an 8 billion RMB incremental. And this 23.6 billion is only on the sales itself, in terms of the cost of revenue to fulfill the 75 million daily orders. Not forgetting, there is also marketing expenses and things like that. So the number will probably easily work out to more than roughly 30 billion. My estimate at least is between 30 to 35 billion RMB to get a 8 billion RMB incremental revenue for quick commerce. And not forgetting the fact that for both Alibaba and Meituan to engage in many of this, both AI build out and this delivery war, they have already started to tap onto the fundraising mechanism in terms of issuing convertible bonds or just normal secured or senior notes. All in all, I think both companies are walking on relatively thin ice, and it's not saying as if Alibaba has such a huge advantage that they can starve out Meituan for the next foreseeable 2 to 3 years and just let them bleed to death. So what we are basically underwriting, firstly, at least going back to the Alibaba case, is that AI demand is definitely a lot bigger than AI hype, and our baseline view is probably going to see a genuine demand surge for the next 2 to 3 years for all these AI resources and cloud needs. So for quick commerce, I think the ultimate hope here is that Alibaba is able to reach some sort of an acceptable unit economics, and they will really be able to turn some sort of a growth down the line. And they'll probably not see wonderful margins, but just good enough so that the overall China e-commerce complex can return to a healthy EBIT and free cash flow profile. And my last 2 points here is that I think Eddie Wu, who's the new CEO of Alibaba Group, is on very tight margins here. He only has 3 years at best to prove his current AI cloud bet and a bit of the quick commerce arm. So the easiest way to count its success is if Ali Cloud is able to eclipse Alibaba's core commerce CMR revenue. At the rate that they are going in terms of their growth, they must maintain more than 30% for the next 3 years, while also managing the decline of their e-commerce arm and making a full transformation to the entire AI and cloud business. I think in terms of their core commerce business, it's not saying that they will decline and cease to exist because of TikTok and JD. It's more like the entire business business or industry is consolidating, it's maturing, they're not going to post huge amount of growth, not in the north of double digits. So they just have to maintain the market share there. It's going to continuously spit out good cash flow and good profits, and they're going to reinvest back into the next cloud bet here. And in that case, I'm not too sure if you guys saw that multiple so-called S-curves. As this e-commerce S-curve kind of plateau, they are trying to bet on the so-called next S-curve. So can they continue to build the next frontier of China's AI and cloud solution while also maintain or hold on to their existing market share that they've painfully carved out with money in the last 2 quarters? I think it's the true test of their strategy and where they go or head into this normalized environment. I think everything is still pretty much in line. They have communicated their strategy earlier this year as they start to size in their investments and spending, and now they're starting to slowly size out as well. So is this a good strategy or not? I think time will tell. Right now, there's a lot of noise in the marketplace on who's going to be the ultimate winner. I think it's not that simple at least. It's going to be a very dynamic marketplace for both AI and cloud and also quick commerce with Meituan. I keep my eyes peeled. I think I'm betting on both horses, but these both horses, instead of focusing on the goal and running ahead, running straight into the competition, they are basically fighting each other out, which is the less than ideal kind of scenario. But I think penciling out into the future, I think I do have pretty good odds. So that's my own perspective. I'll see you in the next video, but more importantly, and hopefully, I'll see you guys on the moon. Goodbye.